Just a few years ago, car dealerships were thriving. Demand was at an all-time high. Inventory was scarce, and prices soared. However, the situation has completely reversed. Dealerships are now struggling with overflowing lots full of unsold cars. Prices are dropping rapidly, and sellers are fighting to stay afloat. If you've been holding off on purchasing a new car, this could be your best opportunity in over a decade, but it won't last forever. Which brands are being hit the hardest, and how you can take advantage of these unprecedented discounts? Stay with me, because the data I'm about to share will change how you view the car market in 2025. Not long ago, dealerships were experiencing one of the most lucrative periods in history. Pandemic-driven supply shortages sent prices skyrocketing, and desperate buyers were willing to pay thousands over the sticker price. Just to get their hands on a new car, buyers were once willing to pay well over the manufacturer's suggested retail price. But now, the landscape has completely changed. Dealerships across the country are overflowing with unsold inventory, and the issue is only worsening. The auto industry made a critical miscalculation when supply chain disruptions eased. Manufacturers ramped up production, expecting demand to stay high. They assumed consumers would continue paying inflated prices as they had in previous years. However, economic conditions shifted rapidly. Inflation reduced disposable income, interest rates on car loans soared, and consumer confidence took a hit. Suddenly, buyers were no longer eager to spend tens of thousands on a new vehicle. This drop in demand has left dealerships in a tough spot, struggling with far more cars than they can sell. Major manufacturers like Ford, General Motors, and Toyota are among the hardest hit, as they had counted on sales continuing to surge. Large trucks and SUVs, once the most profitable segment, are now sitting unsold on dealership lots, worsening the crisis. Used car inventories are also growing, as many people who previously financed vehicles at low interest rates are holding on to their cars longer, reducing the number of trade-ins. At the same time, rental car companies, once major buyers, are scaling back their purchases. The result is an industry-wide inventory surplus that is quickly turning into a financial nightmare. Dealerships are running out of space. Automakers continue pushing more cars onto lots, and the entire system is on the brink of collapse. While dealerships struggle to offload their vehicles, consumers are sending a clear message they're refusing to buy, at least not at these prices. This silent consumer rebellion goes beyond just excess inventory. The bigger issue is that buyers are no longer willing to play along. For years, they had little bargaining power, forced to accept inflated prices due to limited supply. But now, the market has shifted in their favor. However, the balance of power has shifted, and buyers are pushing back. One of the biggest obstacles is the soaring cost of financing a car. Interest rates have climbed to levels unseen in decades, making auto loans significantly more expensive. A vehicle that once seemed affordable now comes with a monthly payment that strains household budgets to the breaking point. On top of that, insurance costs have skyrocketed, with premiums nearly doubling in some areas, driving up the overall cost of car ownership. Rising fuel prices and maintenance expenses only add to the burden, leading many potential buyers to decide that now is simply not the right time to purchase a new car. Another key factor is that consumers are holding out for even bigger discounts. Aware of dealership inventory surpluses, shoppers expect prices to drop further. Instead of rushing to buy now, many are waiting, betting that dealerships will become even more desperate in the months ahead. This shift in consumer mindset has sent shockwaves through the auto industry. Dealerships that once sold vehicles within days of receiving them are now watching as cars remain on lots for weeks or even months without buyers. The longer a car sits unsold, the more it costs the dealership, adding to their financial strain. This change in buyer behavior has forced dealerships to confront a harsh reality: their pricing power is gone, and they no longer control the market. For years, dealerships thrived in a market where they could dictate prices. Supply shortages kept demand high, leaving customers with little choice but to pay whatever was asked. But that era is over, and many dealerships are struggling to adapt. Some have been slow to accept the new reality, stubbornly holding on to outdated pricing strategies. Instead of adjusting to shifting demand, they refuse to lower prices, hoping for a sudden rebound that may never come. However, this reluctance to lower prices is only making matters worse. Unsold cars continue to accumulate carrying costs, with dealerships forced to pay interest on their floor plan loans, cover insurance expenses, and maintain vehicles until they are finally sold. Some dealerships, recognizing the shift in the market, have started cutting prices aggressively. Large trucks and SUVs in particular are seeing steep discounts. Ford, for example, has significantly reduced prices on its F-Series trucks, while General Motors has followed suit with incentives on the Chevrolet Silverado and GMC Sierra. Even 0% financing deals, once rare, are making a comeback as automakers partner with lenders to offer lower interest rates, making monthly payments more manageable. Despite these incentives, the market is not rebounding as quickly as dealerships had hoped. Years of inflated prices and soaring interest rates have left many buyers hesitant, with some holding out for even better deals, and others deciding they simply don't need a new car right now. With consumer resistance at an all-time high, dealerships are facing an identity crisis, struggling to navigate a market they no longer control. Dealerships are being forced to completely rethink their sales strategies, and many are struggling to adapt. Now that they can no longer stick to the old way of doing business, the next phase of this crisis will center on how far they are willing to go to sell these vehicles. Massive discounts, record-low financing, and special incentives are already in play, but the question remains, will it be enough to bring buyers back? The auto industry is experiencing price drops that would have been unimaginable just a few years ago. With dealership lots overflowing, prices are being slashed, especially on high-end trims and full-size trucks. Once highly sought-after models are now sitting unsold for months, forcing manufacturers to step in with massive incentives just to clear inventory. For years, trucks and SUVs were the most profitable segment, with brands like Ford, Ram, and Toyota enjoying booming sales. Now, those very models are among the most heavily discounted, as dealerships scramble to move their stock before the situation worsens. The Ford F-Series trucks, long known for their reliability and market dominance, are now being offered with massive five-figure discounts, sometimes as much as $15,000 off. The Ford Bronco, which dealers once sold above sticker price, is now struggling to move, even with rebates of up to $10,000. Luxury brands are also feeling the heat. The Cadillac Escalade, which once had waiting lists, is now being advertised with discounts exceeding $20,000. The Jeep Grand Wagoneer, introduced as a premium SUV, is failing to attract buyers despite price cuts of over $25,000 on some models. Even performance cars are not immune. The Chevrolet Camaro and Ford Mustang, once in high demand, are now seeing price drops that would have been unthinkable just a few years ago. This dramatic shift underscores how quickly the market has changed. Buyers who once had to compete for inventory are now being courted with unprecedented offers. But the real question remains, are these deep discounts enough to convince people to buy? While new cars are seeing record price cuts, this has created a ripple effect in the used car market, where values are dropping at an alarming rate. The used car market is experiencing a collapse that mirrors the sharp decline in new car prices. Over the past year, trade-in values have fallen by 20% or more, meaning vehicles that were once considered valuable assets are now worth thousands less. For many car owners, this rapid depreciation makes it difficult to trade up to a new model. The cause is straightforward: supply and demand have reversed. During the pandemic, used cars were in high demand due to factory shutdowns and supply chain issues that made new vehicles scarce. Now, with dealership lots overflowing with new inventory, demand for used cars has dried up, This shift has led to a surge in repossessions, as many car owners struggle to keep up with high monthly payments on vehicles that are now worth far less than they owe. Finance companies and banks are repossessing cars at a rate not seen since the last major economic downturn. These repossessed vehicles are then sent to auction, further flooding the market with supply and pushing used car prices even lower. Full-size trucks, luxury SUVs, and electric vehicles, once among the most overvalued segments, are now seeing some of the steepest declines in resale value. A used Ford F-150, which traditionally held its value exceptionally well, has dropped significantly in price. Even the Toyota Tacoma, long considered one of the most reliable trucks in terms of resale value, has seen trade-in values decline for the first time in years. For those considering trading in their vehicle, the timing couldn't be worse, unless upgrading is absolutely necessary. Holding on to your current car may be the smartest financial decision right now. While used car prices are falling across the board, electric vehicles are experiencing an even more dramatic collapse, one that is leaving early adopters facing significant financial losses. Despite automakers pouring billions into EV production, market is in free fall. The warning signs are everywhere. What was once hailed as the future of auto industry has now become an inventory nightmare for dealerships. Electric vehicles are piling up on lots, and dealers are struggling to find buyers. A major reason for this downturn is that many EV owners are now underwater on their loans, meaning they owe far more than their vehicles are worth. This is especially true for those who purchased models like the Ford F-150, Lightning and Tesla Model Y at peak prices, often with dealer markups of $10,000. Now, those same vehicles are being offered with massive discounts, cash incentives, and even 0% financing, yet buyers remain hesitant. Biggest deterrence is the rapid evolution of EV technology. Many early adopters are watching their vehicles become outdated in just a few years as newer models with longer ranges and better features hit the market. This has led to an accelerated depreciation rate, making used EVs difficult to sell at a fair price. Another key issue is the lack of a robust nationwide charging infrastructure. Consumers who were once eager to go electric are now realizing the practical challenges, particularly in areas with limited or unreliable charging stations. Even with steep price cuts, dealerships are finding it nearly impossible to move EV inventory. Some automakers may soon have to drastically reduce EV production as the shift to electrification is proving more difficult than expected. Dealerships are struggling to move inventory, with discounts failing to attract buyers. In response, manufacturers are resorting to another aggressive tactic: 0% financing. But is this strategy as beneficial as it appears, or is it a trap? To counter declining demand, automakers are offering 0% financing deals at levels not seen since the last financial crisis. These promotions aim to make car payments more appealing, encouraging hesitant buyers to take the plunge. However, while these offers seem attractive, they often come with hidden drawbacks that diminish their true value. At first glance, 0% financing looks like free money, allowing buyers to spread payments over several years without paying interest. But the reality is more complex. Automakers and dealerships design these deals to ensure they still turn a profit. One major catch is that they typically require excellent credit. If a buyer's credit score isn't near perfect, they likely won't qualify and will instead be steered toward a higher interest loan, sometimes with rates exceeding 6 to 7%, significantly increasing monthly payments. Additionally, these financing deals often replace cash rebates or direct price cuts. A dealership may offer either 0% financing or a $10,000 discount, but not both. In many cases, opting for a cash payment or a standard loan with a lower purchase price may be the better financial choice. Smart buyers should compare the total cost of each option before committing, as a lower overall price can sometimes be more advantageous than interest-free financing. Another concern is the length of these loans, which are often stretched to 72 or even 84 months. While this reduces monthly payments, it can also mean buyers end up owing more than the car's value for much of the loan term. While monthly payments under a 0% financing deal may seem manageable, buyers often end up paying significantly more in the long run, especially as the vehicle depreciates rapidly. By the time the loan is fully paid off, the car's value may be far lower than the original loan amount, leaving buyers with negative equity. If they choose to trade in or sell the vehicle early, they could face financial losses. The biggest risk, however, is that 0% financing ties buyers to an unpredictable market. If vehicle prices continue to drop, those who purchase today could find themselves paying far more than their car is worth in just a year or two. With the automotive industry in flux, factors such as production cuts, new incentives, or unexpected depreciation trends could make financing a car now riskier than in a more stable market. As automakers struggle with declining demand, dealerships face an urgent question. What happens to all the unsold inventory? The answer to this challenge could have a lasting impact on the industry, as dealers scramble to find solutions for the growing surplus of vehicles. Before these vehicles become financial liabilities, dealerships must act quickly. Unlike everyday consumer goods that can sit on store shelves indefinitely, new cars are depreciating assets, meaning the longer they remain unsold, the more money dealerships lose. So, what happens to all these excess vehicles? One common strategy is redistributing inventory between locations. If a particular model isn't selling well in one area, dealerships may transfer it to another location where demand is higher. This is especially common in large dealership networks with multiple locations in a region. However, with overstocking now a nationwide issue, this approach is becoming less effective. Another option is selling unsold cars at wholesale auctions, where they are purchased by used car dealerships or rental companies. But with used car values declining rapidly, auctions no longer provide the strong returns dealers once relied on. As a result, many are forced to either sell at a loss or hold on to vehicles they can't move. In extreme cases, dealerships may return cars to the manufacturer. Some automakers have buyback programs for unsold inventory, repurposing these vehicles as fleet cars and selling them at deep discounts to rental companies, corporate fleets, or government agencies. While this helps clear stock, it also lowers the overall value of that model, further impacting resale prices. For some cars, the fate is even more severe. They are outright destroyed. This typically happens when a model is discontinued, recalled, or has no viable resale market. Rather than flood the market with heavily discounted vehicles, automakers and dealerships may choose to scrap them entirely. Massive markdowns can hurt a brand's value, forcing automakers to make tough decisions in response to the growing inventory crisis. With unsold cars piling up at dealerships, manufacturers are now under pressure to rethink their production strategies. For years, automakers ramped up production to meet post-pandemic demand, but they are now facing the fallout of overestimating consumer purchasing power. As dealerships struggle to move excess inventory, major manufacturers like Toyota, Ford, and General Motors are being forced to slow production, a shift that could have widespread consequences for the entire auto industry. The industry has transitioned from supply shortages to inventory surpluses, prompting automakers to prioritize efficiency over sheer volume. Ford, for instance, has announced temporary factory shutdowns to prevent further overproduction, even scaling back shifts at its F-Series truck plants, signaling weakening demand for high-priced trucks. Similarly, General Motors has cut production on certain Chevrolet and GMC models that remain unsold. Toyota, known for carefully managing production levels, is now experiencing unexpected slowdowns on key models like the Tacoma and Tundra, forcing the company to adjust its supply chain strategy. Even electric vehicle manufacturers, once believed to be insulated from such issues, are feeling the impact. Brands like Tesla and Rivian have had to scale back output to align with changing consumer preferences. Production cuts don't just slow down assembly lines, they also create ripple effects across the entire industry. Temporary layoffs become common, leaving thousands of workers in uncertain positions. Additionally, suppliers that provide parts to automakers face financial strain as fewer vehicles being built means fewer parts ordered, impacting multiple industries connected to automotive manufacturing. Beyond car manufacturing, production slowdowns can create financial instability for companies that depend on contracts with major automakers, forcing them to adjust operations or lay off employees. The impact extends even further into the broader economy, particularly in regions that rely on auto plants for jobs. When factories reduce or halt production, local businesses, such as restaurants, retail stores, and service industries, often see declining revenue as plant workers face layoffs or reduced hours. Additionally, a slowdown in vehicle manufacturing affects transportation and logistics sectors, as fewer cars mean lower shipping demand. Even the advertising industry could take a hit, with reduced marketing budgets for promoting new models. If the slowdown persists, the effects could reach the stock market, where major automakers and suppliers may experience declining revenues, causing investor confidence to waver. With all these factors in play,